Hello, my name is Anne Iveson and I'm at the 7th Symposium for the Collett Institute of Private Equity entitled The Battle of the Asset Classes. And I'm joined now by Marc St. John, who's a partner at CVC Capital Partners. And we've just had a very interesting panel discussion on diversification and how it has been affected by the increasing regulation. And to that point, what I'd like to know, if I may, Marc, is what are the three things that private equity firms are currently spending a lot of time thinking about or scratching their heads about as all these changes and economic changes take place?
I can't guarantee that I'm going to get it right in terms of all private equity firms, but I can tell you what we're thinking about, and I know that it's being shared by our brethren at other large buyout firms. The first one is this, we talked a little bit about it on the panel, is this amazing flush of capital that's coming in both from the debt and the equity side. So on the debt side, we're seeing the return of Cov Light. It's the last 12 months of the fiscal year here. You've got, I think it's 15% higher than the high water mark of 2007 in the debt markets. So you just get the sense that, again, with quantitative easing and all the banks flush with capital, a lot of money going into the markets, which is making it great for us in some respects, but terrible in others if you're on the buy side, because everything is being pushed up the prices because people can afford 6, 7, 8, now 9 times leverage. And on the equity side, the other issue is that, of course, the LPs are looking at about a 2-to-1 ratio between distributions and capital calls, and so they're flush with capital as well. They're trying to find a place to put this capital, and they're paid to do so. And so if people like us are having caps on our funds and others are either not in the market, et cetera, they've got to find other managers to put money with. And the problem there, of course, is that not everyone can be top quartile. Despite everyone saying that they are, it just can't be. And even we're going to have difficulty, in my view, ever producing outsized returns, just because the markets are difficult and people are human. They're going to make mistakes. So that's the first thing that really bothers us and keeps us up at night is, what are we going to do in this really superheated environment? Now, we've been there before. I've been through several cycles, probably more than I want to remember, and you get through those. But the problem is, going through them is it's a very difficult situation. You're either sitting on capital, and your investors are asking you questions about why aren't you putting it to work? I'm paying you management fees. What's happening? I will say, though, which is very interesting, didn't say this on the panel, but our last fund, which was just coming up to the end of its life, we were not quite at the 90% yet. And we asked our investors if they would give us a vote of approval. 94% came back within 10 days to say fine. And what the message was, and I made it proliferated that within the firm, is that the investors get it. They're saying, look, hang on to your capital. If you don't see any opportunities, don't invest it yet. We're happy to wait for you. And that's interesting, because 15 years ago, that wouldn't have been the case. So that's good in that sense. The other thing that worries us, I think, would be, in longer term, is going to be succession. From our firm's perspective, and I think you're going to see that a lot of other firms, the Blackstones, the Carlyles, the TPGs of the world, and of course we're on our first generation. So they've developed an amazing culture and an amazing way of doing business at CVC, and you just have to look at the returns to see whether or not that's right or not. And the question is going to be, can we continue to proliferate that at the next generation? And so that's something we think about. But not a whole lot, because if the founders think about it too much, then they're sort of they're talking there and thinking their way out of a job. So that's a second thing you can think about. And the third one, I think, would be how we originate transactions. If you can't originate, you haven't started the whole process. You can't invest the money you've done, and you also can't make a return on it. So we're nervous about how do we originate. And as you know, CVC is very much of a geographically driven private equity firm. We're in most major cities in both Western Europe, United States. We're in New York. Probably going to open up a West Coast office, and then of course we're in 8 offices in Asia. So we've got a very good geographic presence, but we're starting to think and ask ourselves the question, do we need to get better sector specialization and sector expertise? And what I mean by that is, look, we've been doing it for 30 years. We know how to invest in businesses, we know how to improve them, but the world is getting so specialized now that maybe we should be thinking about, gosh, we've done already two verticals, which is, as you probably know, financial institutions and TMT. We're thinking, gosh, maybe we should expand that aperture and start finding, healthcare, real estate. What should we be looking at in terms of really knowing that business and those sectors, and more importantly, the cycles, backwards. So those three things, I think, getting into a market now which is really getting white hot and is going to drive returns down as a result. Succession in our case, but I think it's going to be the industry as a general case. And then finally, our origination model in terms of how we source transactions and investments for our LPs.
I think it's very interesting. I think it's a very interesting comment on the maturity of the industry too. And given, as you say, you've been through cycles, but maybe being much more circumspect this time is going to pay you dividends.
I hope so.
Thank you very much indeed for joining us today and speaking on this interview. Thank you.
Thank you, Anne.